SPYD is an ETF that invests in dividend-paying companies in the S&P 500, and of course, the S&P 500 is a group of the 500 largest companies in the stock market. Some of those companies pay out a dividend. This is an ETF that invests in those dividend-paying companies. At the time of me recording this video, SPYD is trading for around $45 a share and is paying out around a 4% dividend, which is about $1.80 a share. I rounded all these numbers to make it a little bit easy to understand. But in addition to this, let's take a look at the last few years, because what we've seen is that the share price has been growing by around 10% a year. Along with that, the dividend yield has been growing by around 5% a year. It's actually been a little bit higher than these, but I'm rounding it down just to keep the numbers simple. Now let's have some fun and run some numbers. But of course, I gotta give you a little disclaimer that I am not a financial advisor and investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. So let's assume that you can invest $1,000 a month into SPYD. Now what's going to happen is every year you're going to make a little bit of dividends. The first few years you're going to make no dividends essentially because, well, you're just starting off your investments. The next few years you're going to make some more. The next few years you're going to make some more. The next few years you're going to make some more. But let's assume now every time you make some dividends that you take these dividends and you reinvest it back into buying more SPYD, and you do this for 45 years because you were smart and you started investing when you were really young. Now, if we assume that SPYD grows at the same rate that we've been seeing over the last few years, now let's take a look at what the numbers will look like. Now, I get it. We're going to see market crashes. We're going to see recessions. We're going to see boom periods over the next 45 years. But historically, guess what? We have seen the stock market rise by around 10% a year, and companies that are paying us strong dividends have also been increasing their dividends despite the market crashes and recessions. So let's take a look at what this looks like. Over the course of your investing career, you invested $540,000 into SPYD, and now when it comes time for you to retire, you are making over $250,000 a year in dividend income. And yes, I am also factoring in taxes, because every time you got paid a dividend, you had to pay taxes, and then you reinvested that money back into here. But still, now you're making a pretty sizable chunk of income. Now, some of you might be wondering, well, Jaspreet, how can I get even better returns? Well, you can invest in more aggressive or higher paying dividends, or you can work to invest more money. But there's one piece of this that I didn't tell you. Remember what we said, that asset prices can rise as well? If we followed this situation where the markets rise by 10% a year on average, well, now your portfolio would be worth right around $10 million. So you have $10 million sitting there, and you're also getting this $250,000 that you can spend without having to worry about selling any of your investments. Past performance does not indicate future performance, but you can start to see the value of investing for dividends, but you can generate cash flow while also seeing asset price growth, and you can use the income from your investments to continue to grow the value of the asset that you own. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.